Good morning, good afternoon, and in some cases, I think it's good evening. I will just wait a moment or two for a few more people to join, and then we'll kick off. Okay, hello and welcome to this webinar, um, Asset Retirement Obligations, What Lies Beneath, where we'll explore the impacts of oil and gas ARO disclosures and what that means for investment decisions. You can access the report awaiting what lies beneath via the QR code shown on the screen. I'm Simon Perrin, part of the engagement team here at Carbon Tracker. Carbon Tracker is an independent not-for-profit think tank looking to accelerate the energy transition through the capital markets. Our research is split into three fundamental core areas: energy supply, energy demand, and energy transition, with a number of cross-cutting initiatives, and is available free from our website and the usual investor-focused third-party aggregators. Today's session will run for up to 50 minutes and will begin with a short presentation from Tino, followed by a panel discussion moderated by Barbara Danison before we open the floor to your questions. The Capital Transparency team's work is divided across several core themes and has a range of products, as you can see along the bottom of the slide. To submit a question today, please use the Q&A function and include your name so our team, if we don't get round to answering this live, can follow up on email later. Joining Tino and Barbara today are Vincent Mayor, Senior Structurer at BNP Paribas Asset Management, and Sue Harding, co-founder of Bailey Network and MD of Harding Analysis. Tino, over to you.
Hi everyone, thank you for joining this morning's webinar. Today I'll be going through our latest report on asset retirement obligations. For this morning's session, I will mainly be focusing on the results for Australia and the UK, and then in the afternoon I'll also be going through the findings for Canada. So to begin, what are asset retirement obligations and why are they relevant? So retirement obligations are obligations that companies have to safely decommission their assets at the end of their productive lives. Often at times, to decommission or retire these assets, it will go on over years into the future, but companies are required to estimate and record these liabilities on their balance sheet. For oil and gas companies in particular, these can be very significant. As you can see in the table, they can be quite sizable relative to shareholder equity or even many times over shareholder equity. And these are the company's own reported figures. This is before we even start to engage in discussions about what potentially might be off balance sheet. So additionally, assumptions and estimates that go into calculating ARO balance sheet amounts could be impacted by things such as economic or regulatory events, including things such as changes in inflation or changes in regulations. And also as some of our previous research has pointed out, the pace of the energy transition is also a big uncertainty, which could impact the size of the entire liability. So I'll just move on to the next slide. So to maybe reiterate, the financial statements don't just capture historical information, but also they include a lot of information that are related to management's forecast of the future. And those forecasts should include considerations of various different factors, such as the energy transition or the pace of the energy transition. And if not, these liabilities could be understated, which could impact things such as management remuneration, investor modeling, as well as the company's ability to continue operating in the future. And so transparency over the judgment and estimates underpinning recorded asset retirement obligations is very, very important. To add to that, existing accounting standards, such as those under IFRS or International Financial Reporting Standards, already require this, and some of these requirements have been recently reinforced by the ISB's recent illustrative examples on reporting uncertainties. So companies should already be providing these disclosures today. However, we saw something quite different. I'll just move on to the next slide, please. So we had a couple of objectives when we were carrying out this transparency scorecard report. So one of which was developing an ARO Transparency Scorecard with the intention of assessing the quality of ARO disclosures of a selection of oil and gas companies. These are some of the world's largest oil and gas companies. And in light of the guidance I mentioned in the previous slide, we focus on companies that prepare their financial statements in accordance with IFRS in Australia, Canada, and the UK. We hope that our analysis would help highlight or identify gaps in disclosures that is material to investors and also society at large. Another objective we had was to create a tool and have a set of results that investors could use in their engagement activities. And also one thing that's not on this slide was we also wanted to review regulatory activity and point ways that regulators could be approaching this issue. Next, please. So in a snapshot, the image you see or the table you see is the transparency scorecard. As you can see, it's grouped into four distinct sections, and they all total to 15. And the four distinct sections are related to disaggregation. So disaggregation by non-current versus current. So what's might be due in a year, whereas versus what's over beyond this period. And then also by disaggregation by type or by activity. So whether or not the company is purely upstream or is an integrated company with asset retirement obligation related to both upstream and downstream. And then another thing we also looked for was whether or not there was a disaggregation or sufficient disaggregation of revisions to the area of liability. So say, for example, assumptions like a discount rate was to change during the year, and also timing was to change during the year, would want a sufficient disaggregation of that. Next, we assess the disclosure. Oh, sorry, if you go back. Yeah, we assess the disclosure of key assumptions and estimates. So as I mentioned already, discount rates. We also looked at inflation rates and things such as the expected timing of cash outflows related to AROs. And then we also looked at sensitivities to those key assumptions and estimates. For some companies, we looked at off-balance sheet ARO disclosures. So one, the description of what was unrecorded, and then two, we also looked at whether or not they provided any detail on what the estimated costs of what was off balance sheet. Um, as I mentioned earlier, this scorecard is reflective of IFRS requirements and also the ISB's recent guidance. As such, is very much representative of the minimal level of information that we should expect from oil and gas companies. Next. Um, so overall, we found that the quality of ARO disclosures was poor and varied very much depending on the company's reporting jurisdictions. I'll cover the results per jurisdiction in more detail in the following slides, but as you can see, oil and gas companies in Australia provided the least amount of information, followed by Canada, followed by the UK. In terms of which company provided the most detail. That was BP, which provided 73% of the information expected under existing requirements. And the lowest scoring company was a four-way tie between four Australian companies who provided only 8% of the information sought. Throughout, it was very clear that investors clearly lack the transparency on AROs for a lot of these companies. Next. So I'll touch upon a couple of these key findings before moving on to the results by jurisdictions. So one of the main ones was that despite the poor results, the ARO information sought by each metric was provided by at least one company. So this shows that the information we were looking for is realistic and reasonable, and that companies can provide it today. In the appendix of the report, we actually have examples of company ARO disclosures that met each metric apart from the last metric. Um, Also, when once we had collected all the data for the report and scored the companies, we looked at potential relationships between scores and the traits or characteristics of individual companies that may further explain these results. So this included whether, it made a difference how large the company was, or the significance of ARO liabilities as a percentage of market cap or shareholder equity. We also looked whether it made a difference on whether companies were more likely to provide better ARO disclosures depending on ARO maturity or what audit firm audited the financial statements. But throughout, we didn't find any apparent relationships between disclosure quality and the characteristics I just mentioned. But the strongest and most apparent potential correlation was between observable regulatory activity by jurisdiction and the quality of ARO disclosures, which leads me on to the jurisdiction slides. Next, please. So I'll cover some of the key highlights of Australia before speaking a little bit about the observable regulatory activity. Effectively, ARO disclosures for Australian companies were opaque and offered little to no detail on assumptions and estimates that management use. This is quite concerning given the significance of these liabilities. If you remember the first slide, which showed AROs as a percentage of shareholder equity. As you can see on the chart, there's also some variance in the quality of disclosures with the percentage of total relevant information provided ranging from 8% all the way to 38%. And for all the Australian companies, the highest scoring metric related to the disclosure of current and long-term ARO liability values, i.e., what percentage of ARO costs are to be incurred in the next 12 months versus beyond this. However, it's important to note that there was often no further detail on timing. So often there was no information on the expected outflows related to decommissioning going out into the future. Another thing to point out is that Australian companies that we assessed weren't, well, typically didn't have, we didn't assess them for off-balance sheet ARO disclosures. This was for two reasons. One, because either the companies had indicated that they didn't have any off-balance sheet AROs, or for those that had offshore assets, they indicated they could retire certain infrastructure like offshore pipelines in situ. Basically, in situ means leaving certain infrastructure on the seabed or in a water column instead of removing it at the end of the productive life, because companies claim that it could have a net environmental benefit. And companies justified this assertion by noting that Australian regulators have previously approved these arrangements. Additionally, some of these companies also provided sensitivities that would assume that, what would be the increase in the ARO liability if regulators were not to approve, retiring their assets in situ. So I'll speak a little bit about Australian regulatory activity. So for Australia, ASIC, or the Australian Securities and Investment Commissions, is responsible for financial reporting, surveillance, as well as investigation and enforcement of accounting and audit requirements. So based on our regulatory or our review of ASIC's regulatory activity, we observed that there was some that was related to AROs. This included indication that ASIC reviewed the quality of ARO disclosures in its surveillance reports. Notably, we also picked up that back in 2022, ASIC had raised concerns about the reasonableness of Woodside's ARO judgments. And following its review, Woodside then recorded an additional 239 million Australian dollars of restoration costs. But beyond this, we noted that it was unclear what other deficiencies ASIC has observed, as well as what recommendations it is giving based on its review of company disclosures. So we noted that more specific focus and emphasis on the quality of disclosures could help improve transparency for Australian companies. Can you move to the next slide, please? So I'll touch on the UK. So of the 38 oil and gas companies, UK oil and gas companies perform better than the peers in Australia and Canada. It was the only jurisdiction to at least partially meet each of the 15 metrics. And relative to companies in Australia, Canada, UK companies did particularly well when it came to providing sensitivities to relevant assumption estimates, especially for sensitivities related to discount rate. The benefit to this is that you're better able to assess the impact on the error liability if discount rates assumptions were to change. And for most of the UK companies, the discount rate used was based on treasury bond yields. So say yields rise or fall, an investor is able to identify how much the error liability might change by, which is useful information to know. Also, a few of the UK companies indicated that they had off-balance sheet AROs, and of these companies, most provided descriptions of what any unrecorded AROs could be related to, such as refining assets that are indefinite lived. However, only Parkmead had details on the estimated cost to settle some of its unrecorded AROs. However, one of the metrics that the UK struggled on was providing a full payment schedule or timing for settling its AROs. Often we would not see any information about timing, or if there was, it was usually incomplete and not granular enough. So for example, some companies would break out their timing of the AROs in 5 or even 10-year chunks. Then beyond, let's say, the 11-year mark, there will be no further detail on timing of cash outflows to decommission their assets. Um, these remaining amounts would usually be quite sizable portions of the total ARO balance, meaning that investors really don't have that much visibility on the outflows of a company. Um, in the UK, the Financial Reporting Council is responsible for regulating financial reporting. And one of the ways they do this is by undertaking thematic reviews on focus areas in corporate reporting. And in our review of regulatory activity by the FRC, we noted that the FRC conducted a thematic review on the application of IAS 37, which is the IFRS standard that governs accounting for error liabilities. In it, they indicated that they indicated what good disclosures look like in the context of AROs. So, for example, they discussed the importance of disclosures on or the quantification of discount rates, as well as the importance of sensitivities. This seemed to match up with what we saw in our assessment of UK companies. However, there are a couple of examples of good disclosures that the FRC had given that do not seem to correlate with our assessments. For example, the FRC had stressed the importance of good disclosures on the expected timing of outflows to settle ARO costs or the timing of AROs. However, as I mentioned, new companies were often poor in this area. I'll just move on to the results next, if you can. Uh, yeah, cool. There. So some of the key action points that we had for oil and gas companies were, I mean, the first one is really just for companies to disclose some of the key underlying assumptions and estimates used to determine the ARO liability on their balance sheet. We also found that it would be beneficial for oil and gas companies to start, regardless of the jurisdiction, to start providing more detail behind the revisions they made. Of to the ARO liability balance, and for those with ARO liabilities related to multiple different segments or activities, it'll be also useful if they disaggregated them. I'll skip the next one as well. So for oh sorry. For investors, if you go back one, yeah. So for investors, I would also encourage them to, use this report to, understand the topic of AROs as well as, you know, play around with the tool and use it in your engagement activities and in seeking for better transparency in financial statements. And again, just to reiterate that the information sought by the scorecard is grounded in existing IFRS standards, and companies should already be providing this. And this information is objective, and management should already have them or should know them at least. And then the next one. And then a few key action points for regulators. So our general recommendation is for regulators to focus on the quality and transparency of AROs, especially in light of the ISB's recent guidance and also the results of the ARO report. Per jurisdiction, ASIC should prioritize all aspects of ARO disclosures and consider thematic reviews, as well as publishing some examples, enforcement actions, as well as good practice. The FRC should dig deeper into areas such as disclosure on revisions and timing, which we identified were incomplete for UK company ARO disclosures. And then with that, I shall hand it over to Barbara Davison, who will moderate the panel for this morning's webinar.
Thank you so much, Tino. That was really helpful. And good morning, good afternoon, good evening, everyone. Thanks for joining our webinar. I want to remind people before we go forward to please don't forget to submit us questions in the Q&A. And also, I'd like to ask the panelists to turn on their video so we can see everyone. And thank you so much to the panelists who have joined us today, especially to Sue. I know it's quite late where she is. Really appreciate we have a really good panel this morning. So I wanted to start off this panel by asking Sue and Vincent to give the audience a brief overview of the work you do and the relevance for ARO disclosures. And maybe shall we start with Sue, please? And you're on, yeah.
Sure, there we go. Yeah, got it. So thanks so much for asking me to participate in this. So I originally qualified as an accountant and auditor. Now I'm an independent consultant. Experience includes standard setting, equity research, credit rating analysis, work with the FRC, etc. But it's always in this intersection of between what investors use of accounting information, what the requirements are, and then companies and the provision of the information. So I think most relevant to the discussion today is work I've been involved in over the last few years on climate-related risk in the financial statements and application of the requirements for transparency under those existing IFRS standards. And as Tino has already suggested, the ISB's illustrative examples, they provide an additional confirmation of the requirements that must be met in a set of IFRS financial statements. And these were published in 2025. They provide incremental certainty on those requirements, and that they should lead to more information on climate-related uncertainties, including those relating to AROs and how they're addressed in the financials. And this should be beginning with 2025 financial statements. So that's really the area that I'll be focusing in on this. And I think, by the way, it largely means disclosure of information that is, in fact, already known by companies because they sort of came up with the assumptions and estimates in preparing the financial statements. So known information is already subject to controls and audit. So it's really a matter of showing for investor use more of the workings on that, the sort of costs, timing, discount rate assumptions that have been made so the financial statements can be understood. And that's really the whole area that I've been focusing on in the last few years.
Thanks, Sue. And we know, based on all this work that we're doing, how important that is. We'll talk a little bit more about the risks and transparency in the panel today. Appreciate that. Moving to Vincent, if you could talk a little bit about your work and how this is relevant to the discussions today, please.
Yes, thanks, Barbara, and good morning, everyone. And again, thanks again for inviting me to this panel. So I work with we've been prepared by asset management for 6 years, and then previously I was part of a bank with different roles. So you may wonder why someone from asset management being on this panel. I think the key element is that, and I think the key, let's say, similarity we can make is the comparison with pension funds. So what we are doing and what I've been doing for the past 6 years now is to set up, structure, and manage decommissioning reserve funds. We know that this kind of concept is far more advanced, or at least more, or let's say regulatory-wise, in the nuclear sector, and more recently is getting more, let's say, looked after on the oil and gas and mining sector. So I think we need to look at it from a really like a pension, and we think it's a good way to put money aside, like for your own pension, to effectively ensure that the decommissioning, when it's due, will be effectively funded. So that's the key element, and I will use this kind of similarity in our further discussion just to show, let's say, practically how it works. I'm happy also that you did this analysis because it's one of the first things I did when I joined 6 years ago, to look at all the decommissioning or ARO from different companies, especially oil and gas sector. And as pointed by Tino, there were a lot of missing information, inconsistency, and it was really amazing. Now I tend to think that probably thanks to AI, we can, very quickly, or it's more difficult for company to hide and to see. You can see all the little print, and I think I kept a sort of a best of a little print where basically this is a number, but we have no clue if it's really a number. But I'm sure you've been through this during your analysis over the past year. So happy to be there, and of course we'll go through the details going forward.
Thank you, Vincent. And I think it's very important to have an asset manager on the call. So we're very, very happy to have you. And yeah, it's important to hear your views on these matters. I think I want to continue with Vincent and following on from Tino's discussion of the ARO scorecard or the ARO disclosure assessments that we did, and talking a little bit more about why this information matters to investors, or how it would matter. So Vincent, how would investors consider this information if they had adequate information about the transparency on the costs and timing? And this includes both for the things on the balance sheet today, the liabilities, as well as what we're calling off-balance sheet or unrecognized obligations. So what would investors do with this information if they did have all of it?
So one of the first things when we did the analysis 7 years ago now, basically I and with my colleague engaged with equity analysts and asked them how we look at all the decommissioning liabilities of, let's say, the major companies. So the BP, the Shell that you mentioned, but all the major, is more the unit base of decommissioning liabilities reported is a billion. And each of them are around 10 to 15 billion. So the top 10 major in oil and gas have more than 120 billion decommissioning liability reported, nothing at the real. And for many, as I also pointed, it's a big amount relative to their equity shares. So it's probably most often the biggest ratio of the total net debt. And despite that, when you engage with equity analysts, or at least a few years ago, they don't really look at it, or at least many of them, because they see it as a very long term. Maybe because there were limited information, they don't really know exactly when and if it's going to happen. So they don't look at it as a key factor. So we were a bit stunned to discover, let's say, the approach or the lack of, let's say, awareness on this topic. Now, fast forward 7 years, and maybe thanks to your own engagement and maybe a bit of also our own engagement, there's definitely more awareness of that. So I take the example of let's say rated agency. We engage with all of them, well, that's the top 4. And also they have a certain view saying that it's not necessarily something they look at the long term, or well, they look for their credit analysis or really as a sort of second order. However, I think there are a few things which are changing. Of course, the accounting is changing. They have started to discover that there's a lot of things which are not properly disclosed. They are from one company to another. The discount rate they use can be significantly different. It also can significantly vary from 1 year to another. Not because the rate curve changed, but because I sometimes feel it that is a way to buffer or manage their total amount of liability. And this is what we noticed, for instance, over the past 10 years. So now we have a database of the past 10 years where the growth of the total ARO is much faster than the growth of let's say, the revenue or free cash flow that those companies generate on average. So yes, equity analysts, investor should be worried about this thing because it's getting bigger and bigger and more and more difficult to ignore. What is important also is that when analysts look at let's say the ARO and what is presented by the company, you realize, as you've seen, that often auditors put a notice saying that they can't really confirm the amount they've been presented because it's probably on the site on the other side of the world, and they have no, let's say, capacity to check. This is also the thing that we did when we challenged the rating agency, say how you can cross-check the figures that you've been, or you can challenge the figures you've been shown. And they said themselves, they cannot do it. So with a sort of, let's say, a common theme where no one can really check or challenge those big numbers. So that's why I would say I would be, as an investor, quite worried about this thing, which is ever, let's say, ballooning, basically. But there are some green shots. So more recently, on the mining sector, but I think we can see that on the same thing on oil and gas. Moody's issued a note saying that now they are getting worried that the amount of liability is massively increasing for ARO, for those companies. And this will impact eventually the rating. That's the first element. Second element, an oil and gas company recently issued a very long-term bonds. And this bond, when I say long-term, it's 15 to 20 years. This bond was treated as a discount, i.e. more expensively from an issuer perspective than, let's say, other company with similar rating profile. One analyst explained that the thing that market expect that those companies will not have enough cash generation to cover their decommissioning limit in 15 years, and they will eventually affect their credit rating. And of course, last but not least, the world of today is clearly not the world of 6 years or 7 years ago. Far more scrutiny on the ESG topics, on the responsibility effectively to properly, let's say, clean whatever they put in place. Increased scrutiny on regulator, so meaning more potential cost for decommissioning. So all that factors increase pressure to disclose more, as you probably should. but also get investors far more worried on this. So I still expect that at one point, we're going to be a big news on one company where basically the decommissioning limit explode, and then suddenly everyone going to look at that as a sort of domino effect on the sector. So I'll stop there because I'm quite passionate like you on this topic, but I'm sure we go more in detail.
Thank you, Vincent. I really appreciate all that. There's a lot to unpack there. And I don't know if we'll have time to look at the auditor comment you made, but that is also a very important topic for us. So thank you. If we move on to Tino, I wanted to maybe ask you if you could expand a little bit on the emissions that you had discussed that we found in the analysis, and the emissions you discussed. I mean, especially things like revisions where those are not actually new or using the actual obligation, but those are changes to the original estimates, or what's important about discount rate changes, timing changes, which is kind of carrying on from what Vincent's saying as well. Could you talk about that a little bit?
There's a little bit about this, but one of the things that we had observed was that when you look at the ARO liability balance on a company's financial statements, you would obviously see various different changes, the unwinding of the discount rate, but then you'd also see changes in estimates. So these are the underlying estimates that are used to calculate the ARO balance. And often there was little transparency, or often it was quite opaque as to what those changes in estimates were or what those revisions were. So for some companies, this could be down to a discount rate changing. It could be down to changes in timing, changes in estimated costs, and often there was little detail on this, and we weren't sure about what was offsetting what. So say, for example, if the discount rate was to go up, this could be offsetting changes in costs going up, for example, because if the discount rate goes up, the ARO liability might go down. But yeah, so there was often a lack of clarity, and I think this was quite universal if you're looking at Australian, Canadian, and also UK companies. I think the only thing that I would know is that I think for some it was obvious that there wouldn't be any changes in certain assumptions and estimates. It's like if the inflation rate assumptions stayed the same, you wouldn't necessarily expect there to be a change in estimate related to inflation rate. But usually there was more going on the ARO balance that we'd want more detail on that we didn't have. But yeah.
Okay, thank you. So there needs to be more transparency over why these estimates are changing. My management's changing their estimates basically on the original liability.
Yeah, exactly.
Thank you. Sue, so you have so much knowledge and information about this, but I wanted to focus on this particular question on off-balance sheet information and why. Can you talk a little bit about why the companies that we looked at might not be providing this off-balance sheet and why they are considered material information? I think you're on mute.
Sorry, it's late here. So yeah, I mean, I think some of the issues relate both to on and off, but maybe there's some particular ones that do relate to off more particularly. I mean, I think more generally, climate risk, the response to it's developing over time, but it seems to sort of be sneaking up on people, and there's no one event that's happening that sort of triggered consideration. And so companies really just have not kept up with the disclosure on this, and yet, as we know, the time frame for fulfillment is only getting closer, and some of the uncertainties are sort of being made more certain. I do think that there's some potential for not understanding what material information looks like for investors. I think some of that mystery is going away, and Vincent mentioned some of the issues, but I think also even just the IASB's effort on these illustrative examples and all of the input they got from investors on just how important information. That was a more generalized climate exercise, but AROs was one of the particular bits of guidance they came out on. So that there's been some help on that. I do think there's potentially not understanding the requirements as well in terms of those off-balance sheet elements. So the standard itself actually says we should end up with off-balance sheet amounts only in extremely rare circumstances, and it does seem to have been or become more prevalent for midstream and downstream that there are off-balance sheet elements. So there's probably something to be looked at there. And I think regarding that off-balance sheet accounting treatment, I mean, it does really seem it's an area that needs addressing. Does the prevalence suggest that that the requirements are not being applied as intended? I think quite frequently we see companies saying that they don't know the precise timing, essentially, or the timing is indeterminate. Well, the requirements don't require the timing to be precise. An estimate should be made of the timing and therefore the obligations on balance sheets. So I think there's some questions to be looked at there. And off balance sheet accounting, Vincent mentioned pensions. I think AROs off balance sheet is sort of a last area of off balance sheet treatment. Pensions have been brought onto balance sheets. Lease obligations have been brought in onto balance sheets. Some of the off balance sheet securitization vehicles and whatnot that may probably have led to the financial crisis have now been brought onto balance sheet. Well, this is a big area that still remains off balance sheet, and I think needs some attention, both from a compliance standpoint on possibly the numbers, but certainly then disclosure of what is sort of lurking there. Because as soon as that timing becomes more determinate, they will come on the balance sheet. They exist.
Sorry, I couldn't find my unmute. Yeah, thank you. That's very, look, we're looking at, like you alluded to pensions and leases, and the size of these AROs, they're like, we've seen multiples of the shareholders' equity, multiples of market cap. So, I mean, these are massive items sitting off balance sheet. And like you said, they will occur. So, and they could accelerate. So thank you. Actually, staying with you, I think you've talked a little bit about why the accounting guidance is so important already. I'm happy for you to expand if you'd like, but I wanted to ask you two follow-up questions. One is about if this information is actually already required, why aren't companies providing it today, or why do you think they aren't providing it? And then what do you think we should be reasonably expect to see now that this guidance is out from companies, in the next year?
Yeah, well, I guess I touched a little bit on why some of the why maybe some of the information isn't being required. I think one thing to say about these illustrative examples is that they address 6 specific disclosure requirements. Each of those was raised in the context of climate risk and transition, which also relates to AROs and possibly bringing them forward. And the aim is to improve the application. There have been questions as to whether we need new requirements, but the IASB, and I would agree that existing ones are sufficient to address the issue, and we can't just ignore the requirements, or add more ones that might not be applied either. We need the requirements to be applied. But I think there's going to be challenges in this, and I think one of the challenges is these illustrative examples are not prescriptive. They illustrate the application of principles because IFRS is principle based. They're sort of indicative of how to consider meeting the requirements, and there's going to be a need for consideration of them by analogy, looking at the requirements, the IEs and the illustration provided, and then companies thinking about their own circumstances. And if I think about decommissioning, this is going to be really important. There's an illustrative example that talks about a circumstance for those very small ARO provisions, but the expected cash flows are significant. There's increasing risk of early settlement. Therefore, additional information on things like the assumptions and estimates made is deemed to be material information and should be provided. But so they don't then specify, well, what about big provisions? Well, you would think if little provisions need more disclosures, then big provisions need more disclosures. And what about what about the information on at least the cost level estimates of the off-balance sheet obligations? So I think really pulling all of this together, it really is has the potential for changing the level of disclosure and more consistency and more meaningful information. But really, companies, auditors, and regulators need to consider the illustrations, the underlying standards, because that's where the strength comes from. That's the requirement. It's in the standards. And identify company by company what needs to be provided. And this is effectively what you at Carbon Tracker have done in this study, is look at the requirements, the illustrative examples, think about big AROs in relation to this topic, and then make it more specific and think about what that material information would be. So effectively, you've sort of mirrored what needs to be done at company auditor and regulator level to consider the change that should occur. So we hope those numbers will be up next year. More disclosure.
Thank you, Sue. Thanks very much. Moving on, let's see, we have 5 minutes left for our panel, and talking a little bit more about the risks related to this. So, Tina, really quickly, could you remind the audience why the variation that we've seen by jurisdiction in disclosures is an issue?
Yeah, I mean, it's a big issue, like one from the perspective of comparability, right? These are companies operating within the same sector that often have similar characteristics. So if you've got varying levels of information, you can't necessarily compare it, and there's holes in one company's disclosure versus another company's disclosure. So that's a massive risk as well for investors as well. And yeah, I think that, yeah.
Thank you. And they're also all applying the same accounting standards, the ones we
Exactly.
looked at. So any difference, we've seen how that can impact a liability. It's important for investors to understand where the differences are. And moving on to the investor again, Vincent, you've talked about underfunding and relationships between these and pension plans. I mean, what are the risks to not actually adequately understanding and managing these decommissioning obligations for oil and gas assets? And maybe moving on from that with your funding comment, do you think that the costs are adequately covered today?
Okay, so it's there are a lot of challenges here. So in the oil and gas sector, first of all, there are very few cases where there are some pre-funding, either at the initiative of a company or because of regulation asked for it. So you have few companies or few countries which are now asking to put that in the pre-funding. So Angola, Nigeria, some country in West Africa also. And you have also, to some extent, Petronas in Asia Pacific having a sort of decommissioning funds. Difficult to know exactly the amount. I think it's few hundred millions, but I think relative to the total amount of liability, is still a small amount, but of course better than nothing. So there are, I would say, some green shoots around the world, and also based on the lesson of, unfortunately, what happened in Nigeria, a lot of company basically went bust and left the oil and gas in the middle of the sea with all the pollution generated by that. So that's of course something we want to avoid. That's the first element. The second element, in terms of risk and adequately, let's say, understanding or let's say sizing the obligation. Sue made allusion to the scope of, let's say, ARO. I also point out to the, let's say, the timing and the amount itself. So timing, I tend to agree with the operator. We are not necessarily keen to show an exact timeline because typically that is quite function of their own technology to extract oil and is increasing through time, but also the price of oil. And when oil was at more than $100 a barrel, it makes sense maybe to carry on, doing extracting oil in some old oil and gas field in North Sea. Today at 60, it may not be the case. But here come a very important thing is that the lower the price of your commodity goes, the earlier you're likely to decommission. But by that time, the more likely you have less generated cash flow, so revenue. So you have a negative correlation between the timing of decommissioning and the available cash you have in case you have to not put money aside. So I think it's really an early warning. I want to really insist. Second is the amount of decommissioning which has been provisioned. Under the accounting, it says that you have to estimate the probable amount. Probable amount means that you have to cover at least in 50% of the case. But are you happy to have an insurance or pension? We will cover or what you need for retirement only in 50% of the case. So meaning that the amount is in fact far more important than it should be in reality. And we have a good example in the North Sea where the public information, where they analyze that overall the cost of effectively decommissioning was 76% higher than initially budgeted. And I think it's very important because it's probably one of the most, let's say, regulated area where you can see on the website that every site, the operator have to put all their decommissioning plans. It's multiple pages, so if you're an engineer, you love it. So, but of course, there are some countries they don't have to do that. So I'm sure that there are probably better estimate in the North Sea, and they're still 70% off the amount. So I think it's really kind of important to highlight this kind of, let's say, issues in terms of scope, timing, i.e. early timing means higher cost, and of course, the real cost once decommissioning. So all of this, as an investor, you need to make sure that you potentially anticipate that. And I will also try to use an analysis. We are keen to basically, when you have some put money in it, you invest into project company which are not correlated to the business you engage with. Because of course, to avoid this kind of negative correlation, because today companies say, oh, I'll use my own cash flow when I have to basically do the decommissioning. But if it happens that oil and gas now is crushing, well, at least half the price it was 3 years ago, you have is really low. Murphy's law where you don't have the money when you need the money. So it's really important to say that, because today, not provisioning, not putting money aside for decommissioning liability, it's like basically asking your own employee to put 100% of their pension fund into the share of their own company. Who wants to do that? So they are fully, let's say, relying on the risk of a company being still credit worthy when you're gonna retire. So that's really important. I really want to highlight that, especially when on the balance sheet of those company, we know that the amount is declared and the scope is debatable, but and also the risk that ultimately we all basically will suffer, because if a company cannot fit the bill, I mean, eventually the taxpayer and all of us will take the bill.
Yeah, thank you, Vincent. I mean, there's so much, we've covered so much in this webinar, and there's so many things to cover, right? There's so many more discussions to have. And I apologize that we've run out of time. We're over now. So what I'm going to do is just ask each panelist briefly to maybe talk about in half a minute what can we do going forward to improve this? And should we start? I'm going to go Tino first, then Sue, then we'll end again with Vincent. Tino, please, 30 seconds.
Okay. In short, read the report. But also, I think I definitely advise, be it with investors, be it regulators, to really take or pay attention to the illustrative examples, and to really look at what good disclosures means. And I think using our report and the methodology and the scorecard we've provided and the illustrative examples, it's a good starting point for understanding, what disclosure is needed to fully understand these asset retirement obligations. And yeah.
Thank you. Sue. Oh, you're on mute.
Apologies, sorry about that. I'll have to be even shorter now. Yeah, I mean, I just think we're at a really crucial point. The IEs are out. They came out late last year. Yeah, it's a best efforts, I think, approach this year for companies to disclose in their 2025 accounts. The information is inherently important for all of the reasons that have been cited. And there's compliance issues that may be associated with it, but this is a really big economic obligation that needs to be funded, hopefully not by taxpayers, but by the companies that are on the hook by the industry regulators to complete the work. And I think it's also such a basis. Accounts are such a basis for sustainable investment in terms of what's not going to result in further stranded assets and the like too. So I think just taking all of this into account, it's a big issue. We need the transparency to sort of transition on a more planned basis and avoid the harm that will result if we haven't planned it properly.
Thank you, Sue. And Vincent, you have the last word before we have a couple minutes for questions.
Okay, so very quickly, I would say, as you said, information, awareness, and I would say also action. Action because, I mean, on one hand, it's a strategic topic. CFO, CEO don't really want to look at this kind of long-term issue, which is ballooning. We consider it's going to be the mandate of the successor. So that's the issue. On the investor side also, they say, okay, it will not necessarily affect my equity in the short term, so don't really look at it. So I think it's very important that there's an awareness on this. Now, I think we need to see it positively. There are a way to manage that, to create value, to convert. So not seeing this kind of site in the middle of nowhere as a purely liability, but there are some initiatives to convert them. I will not go in detail here, but it's not and create value, or at least minimize or control the cost. So really, it's my key messages here. I think also that regulators should come and support, let's say pre-funding, and in a way, and sorry to make another allusion to pension. They should today, when you decommission in North Sea, you get a tax credit when you effectively decommission. My view is that you should get tax credit when you start to put money into let's say the pension for decommissioning, like it is for us. So it incentivizes you to basically put money aside earlier rather than waiting at the end. So at the moment, there's a counter, let's say, counter effect by the way it's currently set up.
Thank you so much, Vincent, because it's good to hear what positive things can be done. I don't know how much time we have, but there are a couple questions on here I'd like to try to address. And actually, I'm going to ask Sue if she can address one, hopefully. I don't know if, Sue, you can see there's a question here asking if it's really reasonable to expect upstream companies to disclose the expected timing of decommissioning when it may be commercially sensitive and depends on a range of unpredictable factors, which I think a lot of this has to do with what we're talking about today. So, Sue, are you happy to answer that question?
Well, to a degree, yes. I think, they are making these estimates, cost, timing, inflation, discount rate. They're making all of these estimates. So I think it is a bit of just showing some further workings as to what the broad estimates have been. I would also say on this whole timing issue, they do depreciate assets over time or over units of production. There is a life implied by that. So I don't see that why then suggesting that at the end of what they have already disclosed on depreciation and finite lives, they couldn't just follow it a little bit through and suggest, at least in those sort of broad buckets, as Tino said, maybe it's every 5 years, buckets of what the timing would look like. I don't think that's unreasonable or commercially sensitive, frankly. It is uncertain, which is precisely why we need information on the assumptions that have been made. And then, grown-ups know the assumptions probably will be wrong and they will change. But with no information, the element of surprise and then outrage over why the information wasn't provided, why material information wasn't provided sooner, is just going to be more complicated.
Thank you, Sue. And I can see Simon looking at me sternly because we only have 1 minute left. So I think we can answer the other questions via email. And I'm going to hand back over. And thank you so much once more to the panel. I'll hand back over to Simon.
Thanks, Barbara. Great. I was giving you my best Paddington Bear stare. Thank you to all of the panelists today, all of the speakers. A great panel, I thought. Personally, I thought the pensions analogy was absolutely bang on. We've got pensions, our pensions on the balance sheet. Why can't we have the assets of the company's pensions on the balance sheet? And I think that's my takeaway today. So a copy of the slides again and a recording will be sent to you all in the next day or two. And if you have any follow-up questions, please get in touch via my email, sperham@carbontracker.org. Next from Carbon Tracker is the launch, and it's this week, of our report in association with the Exeter University, Recalibrating Climate Risk, and is a roadmap for fixing climate scenario analysis by closing the scientific and economic gap. And if you're interested in the investment risk of agricultural methane, check out our sister company, Planet Tracker's new report, which was launched yesterday. Both of these reports are will be available on our websites. And until then, thank you for spending the time with us this morning, and have a great rest of the day. Bye-bye.